Time to get some common sense from Craig Bolanos, the founder and CEO of Wealth Management Group. Craig, what can you tell us?
Angela, let's talk about saving people money on their taxes. And typically once we close out the year, we say what's done is done, but that's not necessarily the case when it comes to saving on your personal income tax bill. We've got 3 strategies that you can still do today in 2022 to lower your liability for the previous year or increase your refund. Number 1 on my list, add to your individual retirement accounts. I mean, by the way, your future retirement self will thank you, but you can contribute up to $6,000 to a deductible IRA, $7,000 if you're over the age of 50, as long as you have earned income and your workplace retirement plan and AGI doesn't disqualify you from the deduction. Number 2, contribute to a spousal IRA. If you're legally married and your spouse does not work, that does not mean he or she can't make a deductible IRA contribution. There's a provision in the tax code for spousal IRAs, so be sure to take advantage of this to boost your family's retirement savings. And number 3 on the list, it's all about healthcare. I want you to consider establishing a health savings account. And the health savings account is triple tax preference. That's tax deductible contributions, tax deferred growth, and tax-free distributions that you can use to pay for unreimbursed medical expenses or retiree Medicare premiums.
What else should taxpayers or investors consider?
Well, we've discussed on your program before the importance of seeking to diversify away people's biggest expense, which might just be the same as their biggest future risk, and that's taxes in retirement. Getting money into the tax-free safety zone of the Roth IRA is mission critical for many. And with stock markets having been volatile to start the year, it makes it an ideal time to consider performing a partial Roth IRA conversion now, given equity prices are low, and maybe following that up with an additional conversion later this year once people have more visibility into their total income. And there's 3 key elements to remember. First, determine how much room you anticipate having to convert while not bumping into the next higher tax bracket. 2, get some professional help. It's not just the tax brackets. You want to make sure if you do a Roth conversion, you don't inadvertently phase out of any tax credits or deductions that you would have otherwise been entitled to prior to doing the conversion. And number 3, make sure you've identified a plan as to how you're going to satisfy the taxes on that Roth conversion. But hear me say this time and time again, being tax diversified in retirement, getting money into the tax-free safety zone, it's mission critical to diversify away your future tax risk. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you want to learn more, you can. Check out our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.